Hey everyone, Clint here, Larry's analyst over at the Opportunistic Trader. Today, I want to talk to you a little bit about next year and something that I think could have really big ramifications for the stock market. It's something that is flying under the radar. Not a lot of people are discussing this right now, but there's really a confluence of factors that are coming together that could drive some volatility in the stock market, something that's going to come from outside the stock market, and that is with the bond market. And so there's precedent for this. The precedent is during the 1990s, early 1990s. You can look this up. There's this whole episode with what they called the bond vigilantes. And basically, what it was is during the early years of the Clinton administration, concerns over deficit and debt levels, concerns over spending plans caused whether it was a buyer's revolt, investors not wanting to go into fixed income securities or outright selling fixed income securities, whatever the case may be, you had a serious backup in longer dated yield. So the yield on the 10-year Treasury went from a little over 5% in late 1993 and didn't peak out until late 1994 at a little over 8%. So again, going from around 5% to 8% in the span of a year, which forced the administration and Congress to abandon some of their spending plans to rethink things and to focus on deficit reduction. And when that happened, you started to see yields start to fall back down again. So there's several things that are happening in 2026 that have been happening this year as well that are kind of coming together at the same time, where I think you could see some bond market volatility, and that would have a direct impact on the stock market through a couple different avenues. And that's what I want to talk about today. I've got a few charts that I want to go through to highlight just some of the challenges that's facing the federal fiscal situation next year, some of the imbalances that are out there, and a couple things that you can watch that we can track to see if concerns over the bond market are going to start to expand. All right, so the first factor that could drive increasing bond market volatility in 2026 has to do with a massive wave of refinancing existing debt that is going to come due. So a lot of this debt was issued back in 2021, coming off of the pandemic and related to all these stimulus efforts to offset the impact of the economy at that time. Well, a lot of that, there's a lot coming due this year. So this chart looks at U.S. Treasury debt outstanding by maturity, so by year. And you can see in 2026, 34% of all outstanding U.S. Treasury debt is going to mature. We're talking about $10 to $11 trillion of U.S. Treasuries that needs to be refinanced. And so, again, this debt has to be refinanced. So this is old debt that needs to be refinanced. It's not going to be paid down. It's going to be rolled forward. It needs to be refinanced. But at the same time, you have this massive wall of refinancing that needs to take place. There is a lot of new issuance coming down the pipeline as well. And so that's what the chart on here is showing. This shows the federal deficits relative to the size of the economy. And it breaks it down between the deficit and net interest payments to come up with a total deficit or surplus. So what you want to track on here is this line. And again, this looks at the deficit or surplus relative to the size of the economy, so as a percent of GDP. And what you can see is that deficits are expected to continue running at a really high level relative to the size of the economy over the next decade. This is projected by the CBO, the Congressional Budget Office, with current policy that's in place and making some assumptions on the economy. This is what's forecasted in terms of deficit spending over the next decade. You can see deficit spending is running around 6% or so of GDP. And so, again, so we've got this wave of maturities hitting this year that needs to be refinanced, but with large deficits in place still. That's this just new debt that has to be issued. And now the other thing to consider with this is that this is probably making assumptions that the economy continues to grow over this time. If the economy were to hit a rough patch, you tend to see deficits push much higher during those episodes. So, like, here's in the aftermath of 2008 and the spike in the deficit around the pandemic. That's because, in a recession, tax revenues dry up, but then government spending is also supposed to kick in through unemployment schemes or stimulus spending, or maybe it's bailouts, whatever the case may be. Government spending gets kicked into higher gear while tax revenues dry up, and so this doesn't really take any adverse scenario like that into account. So just something to be aware of there as well. So the other thing to consider is that if you have deficits running relative to GDP that are larger than GDP growth itself, that will not keep overall debt to GDP steady. So that's the other thing to watch heading into next year and years beyond, really, is and how the market is viewing this. Because if we're running deficit levels that are consistently between 6 to 7% of GDP, while you need GDP growth to match or outpace it if you want to keep debt to GDP levels steady. And so the chart on here is showing that debt to GDP ratio going all the way back to 1940. So, and over this time frame is kind of that post World War II is when we saw debt to GDP max out over 100%. We've been steadily increasing since 2000, and based again using the projections of where deficit spending looks set to run over the next decade. Right now, it's being forecasted that debt to GDP sometime in the years ahead could hit record high levels. So, again, just taking all this into consideration, you have a big wall of treasuries that mature this year that need to be refinanced. You have a new supply of treasuries that need to be issued to cover the deficit. And at the same time that all this is happening, you already have debt to GDP levels running near the highest levels we've seen over the past 100 years or so. All right, so if I've heard, so here's the thing, I've heard of concerns about deficits, debt to GDP levels for as long as I can remember, and it's never really been a huge lingering long-term issue for the market. There might be some scares from time to time, kind of going back to that bond vigilante episode, but there's never been, a really big fiscal or a crisis that's focused on the state of public finances. So, that's one thing to watch for next year. And what are some of the things we can look for? Some of the warning signs that are there that we are going to see this is concerned over the bond market, see increased bond market volatility, and how that could spill over into the stock market. So one area obviously to keep an eye on is what bond yields themselves. So highlighted during the 1990s episode, the 10-year yield went from a little over 5% up to 8%. Watch bond yields in that regard as well. One thing I wanted to highlight on here is that bond yields on a global basis has already been rising, because look, the U.S. is not alone in some of this, in some of the fiscal stimulus, in the deficit spending. We've seen that in Germany this year. We're seeing that in Japan as well, and in those countries, you've seen longer dated government bond yields jumping higher. And so, watch for something similar here in the U.S. But this just shows. Again, this is a global gauge of long-dated bond yields that really, bottomed out in 2020 around the pandemic and started to, we had a significant move higher starting in 2022. And remember, we had a bear market back then. So this jump in yields coincided with the bear market that we had during that year. And since then, it's, overall, the uptrend is still intact, although it's been much more measured relative to what you saw in 2022. A big part of that is because I'm not sure how this index is weighted, but assuming if it's weighted by, GDP, so to speak, the U.S. would have a large bearing on this. And back in 2022, yields were ramping significantly higher in the U.S., especially on the long end. So keep an eye on 10-year and 30-year U.S. Treasury yields. We've been kind of just trading sideways in a range for the last couple of years now. If we start to break out of those ranges, that would be one warning sign that all these things that we're talking about is becoming a bigger concern for the market. Another thing that could hint at growing concerns over fiscal imbalances in the U.S. is with the U.S. dollar index. So similar to talking about how a buyer strike can drive bond yields higher. Well, a buyer strike, if you don't want to hold U.S. dollars, a buyer strike could drive the U.S. dollar index lower as well. And this is something that gained some attention this year, but not nearly enough as I think it warranted. And that is the U.S. dollar index. So this measures the U.S. dollar against a basket of other currencies. The other major currencies are a bigger weight in this. Things like the euro, the yen, so on. But the dollar index had at the midpoint of the year, the dollar index was down 10% on the year, which doesn't sound like a lot, but for something as critical to the global financial system as the U.S. dollar, that's a big decline. That is the biggest decline since 1973. But you can see the dollar found the low, stabilized, and has just been trading sideways since then. And so, but this is something I would keep an eye on. That if concerns over the fiscal state of the U.S. starts to grow, I would expect to see the dollar index deteriorate further. And we've had some recent deterioration that we've been pointing out in some of our commentaries. So one thing that we saw was this 100 level is actually pretty key on the index. So we lost the 100 level. And we've come back and we're testing it several times. On the most recent test of the 100 level, we're seeing just a modest negative momentum divergence. So the RSI down here in the bottom panel making a lower high, and that gave way to more of a pullback in the dollar. So this blue line is a 50-day moving average. So we crossed below the 50-day moving average, chopped around there for a period, and then started to slide again after the Fed cut interest rates at their last meeting in December. But what I would watch for on this chart is if that weakness starts to take us back down to the lows that we saw this year in 2025. So, between 196, that's kind of the trading range that we're in. If we see the dollar start to break these lows, if the dollar keeps pulling back and falls below the $96 level, or the 96 level on DXY is the ticker in most places for the US dollar index. If DXY takes out that 96 level and embarks on another leg lower, to me, part of that is signaling concern, over whether it's the U.S. economic outlook, but also potentially the concerns over these fiscal imbalances with the U.S. and what you're seeing with refinancing to take place, along with the new supply of Treasury debt. All right, so then how does this ultimately spill over into the stock market? Well, there's really two avenues you need to watch for. One is if the one result of bond market volatility is rising yields, especially on the longer end, that directly impacts borrowing costs for companies, for consumers. So it slows economic activity. There's impacts the bottom line. There's an earnings impact if borrowing costs are rising. So that's one avenue. The other avenue that I think could be even more impactful, given where the market is right now, is through valuations. So interest rates are, the way the discounting mechanism works is that you use interest rates to derive the present value of future expected profits. And when you assume a higher interest rate, the present value of those future expected profits shrinks. And here's why that's especially important this time around, is because valuations are getting pushed to extremely high levels. I'm covering this in another commentary video update on the state of valuations, but right now The S&P 500's forward PE ratio is over 22 times. I think the only other time we've been higher than that was heading into the internet bubble in the late 1990s. So, given the state of valuations, rising yields, and their impact on sort of that discounting mechanism for figuring out for deriving the present value of future expected profits for the stock market, that could be a major impact as well. So that's all for today. Again, this is watch for terms like bond market vigilantes start to be thrown around. Watch for rising yields. Watch for a falling dollar. If you start to see those things hit the headlines more and more, I think that could be a major catalyst that impacts the stock market in 2026 that no one's really talking about right now.